Technology stocks continued to be the best performing sector in the first half of 2018, driven by strong earnings and solid fundamentals. Volatility has picked up this year as expected, driven by some concerns over higher interest rates and rising trade war tensions. We do not view the recent weakness in tech stocks as a signal of an impending correction, but a combination of profit-taking after a decent run, some rotations into defensive sectors, and rising tail risks related to a bigger trade war. While some stocks have corrected relatively sharply in a short period of time, those movements remain within expected statistical ranges. As we look to the second half of 2018, we continue to believe the fundamental backdrop for companies related to artificial intelligence has never been stronger. And we do not believe the flattish yield curve is a forewarning sign of slowing economic activity in the coming year. As bottoms-up fundamental investors, we focus on the company's execution of their business strategy and corresponding earnings growth. The companies held in the portfolio are indeed performing well, as we expected, with solid financial results and growth outlook. And we feel confident that their share price will follow their earnings growth over time. The strength in the performance in the technology sector has primarily been in the U.S. markets, as the fear of trade war has weighed more on Asia tech stocks more recently. But most U.S. stocks are global in nature, they have more diversified revenue exposure, and are typically more immune to the market's volatility. Performance has really been driven by strong end demand drivers, such as AI, big data, and cloud, that are showing strengthening fundamentals in the industry. The world economy is more connected today than it has ever been, and the U.S. and China are dependent on each other. In technology, China depends on the U.S. for semiconductors, critical components, software, and intellectual property, while the U.S. depends on China for manufacturing and assembly. To date, there have been no specific tariffs on critical technologies to China and vice versa. It's been mostly on commodity products or products that have available substitutes. Despite the noise and tone of recent headlines, we believe it is in everyone's best interest to come to a trade agreement, although it's difficult to predict the exact timing. There are tail risks to a potential trade war, but in a base case scenario, these tariffs should not derail the current fairly robust economic activity and earnings growth outlook. Nevertheless, uncertainty is high, and markets do not like uncertainty, which is leading to higher market volatility in the near term. We don't believe the volatility caused by the trade rhetoric will change the long-term opportunity presented by artificial intelligence. However, we expect there could be several months of volatility related to these issues until a trade deal is signed. In times of elevated volatility, our risk management process and staying active is critical. This provides us with more opportunities to take advantage of pullbacks and higher conviction ideas and construct a portfolio with compelling risk-return potential as the market recovers. Allianz Global Investors' San Francisco team has decades of experience covering the tech sector, field expertise within the industry, and deep relationships across Silicon Valley, with global dedicated resources. Senior team members of the AI Fund have over 18 years of industry and tech sector experience managing portfolios with a strong track record of success investing during periods of rapid change and disruption. We believe that we are still at the beginning phases of a global transformation that will be ushered in by the developments in AI. We believe that stock picking will be imperative to capturing the benefits of this opportunity, especially in an environment characterized by higher volatility and greater dispersion of returns. That said, the outlook for companies advancing and leveraging AI continues to trend favorably. We remain optimistic that our portfolio of companies can deliver attractive returns for our investors over time. AI is a foundational technology being used by more companies every day. The Allianz Global Artificial Intelligence Fund seeks to invest in companies that stand to benefit the most from three areas: the deployment of AI infrastructure and secondary enabling technologies critical to the growth of AI. AI infrastructure includes companies in the semiconductor, electronic components, and software sectors, helping to enable the build-out of the AI ecosystem. Second, the development of AI software and applications to make smarter insights and decisions. AI applications are helping to drive higher levels of automation, better recommendations, faster decision-making, and significant cost savings. The third area is the adoption of AI in key vertical business processes to drive AI-enabled industries. Many companies in the automotive, consumer, healthcare, and finance sectors are already seeing the early benefits from AI, which is allowing them to deliver unique products and services, enabling them to outperform their industry peers. We believe constructing a diversified portfolio tied to these three areas of AI has the potential for attractive risk-adjusted returns for our investors. Artificial intelligence is likely to be the largest driver of innovation and disruption across every industry group for decades to come. AI will be woven into everyday life and will make many products and services better. We think the first wave of AI is really human-assisted, helping to make jobs better, taking the workload off of us, making us more productive. The technology is very broad and will be horizontally adopted in every industry and drive new levels of productivity, time savings, and enhancements. We believe AI could be bigger and more profound impact on people's lives and society and even the internet. This inflection point represents an exciting opportunity to access the future sources of innovation and growth, potentially across the market. The pace of advancement in AI is accelerating, with new breakthroughs seemingly happening every day. There are many examples of how AI is driving innovation in various industries. For example, in agriculture, companies are using autonomous drones to help farmers survey their land, taking images that reveal things like fertility of specific patches of soil and how much water the crops need. AI is also being used to help improve crop yields by predicting various environmental changes and the presence of weeds or diseases. In healthcare, AI is being trained on X-ray images and achieving accuracy rates better than most human doctors in diagnosing a number of illnesses, from cancer cells to diabetes, to pneumonia, to rare blood infections. In electronic medical records, AI is helping to predict the risk of heart attacks or other diseases in patients. Recently, a neural network was trained to recently predict chemical reactions, which could significantly accelerate the creation of new drugs. We are just scratching the surface of what AI technologies can do to help make doctors better, more efficient, and improve the quality of care in the future. In retail, companies are leveraging AI and machine learning technology to help create a more interactive and personal experience for consumers. AI-powered assistants can now answer questions about products and availability when you walk into a physical store. Deep learning is being used to better understand a customer's personal style and search for similar items of clothing with different features, like a different cut or color combination. 3D sensing and augmented reality technologies are enabling new virtual fitting rooms to give shoppers a richer experience before purchasing. These are just a few examples of how AI is starting to change our everyday life. And we believe that the future with AI technologies, it will continue to create a better experience for us in the future.
安聯投資